welcome to this special program. I'm Ankita Mukherjee. We're going to be focusing in the next half hour on your questions in the aftermath of global giant Franklin Templeton's unprecedented closure of 6 funds in India. That happened on the 23rd of April. These 6 schemes will now not allow any further transactions, purchases or redemptions, which means that currently at least 25,000 crore rupees of investor money is stuck. These closures have sparked worries of panic withdrawals from other Franklin Templeton funds as well as funds of other asset management companies as well. Distraught investors who can no longer access their money at this point are also calling for regulators to step in and help them. Over the next half hour, we're joined by mutual fund experts to answer your questions on this debt front crisis amid the coronavirus outbreak. We're asking you to tweet your questions to NDTV. You can also call us on that number on your screen, 83770-88377. And we're going to be taking up your questions live on the show. We're joined by Nilesh Shah, Chairman, the Association of Mutual Funds in India, who's also the MD of the Kotak Mahindra Asset Management Company Limited. Dhirendra Kumar, Chief Executive of Value Research, is with us, as is A. Balasubramanian, MD and CEO of Aditya Birla Sun Life AMC. We're also going to be joined in a short while by Nimesh Shah, CEO and MD of ICICI Prudential AMC as well. All right, I'm going to throw this open for questions, but our viewers have already been writing in to us with many of their questions, and I'd like to take some of those across directly to our expert panelists. There are, of course, questions that the investor has, the specific Franklin Templeton investor who is right now being unable to access their investments. There are also questions that other investors have at this point. And then, of course, there are the larger questions which are related to the broader economy as well. So we'll try and take all of those up in the course of the next half an hour. But let's focus at least initially on the specific Franklin Templeton crisis. This unprecedented move by a global giant to shut down 6 of these debt schemes. What is this going to mean for the Franklin Templeton investor? And our first question is specifically related to that. If you can get that up on our screens. What is this going to mean for investors in Franklin Templeton schemes? And let's get an AMC perspective on this. Mr. Balasubramaniam, if you want to take that.
Yeah, I think it's as we have seen in the last 1.5 months, a completely unprecedented time post the COVID hit the world, and the equity market we saw a significant fall, and then we also saw some of credit-related issues, bond market liquidity not being so much available, especially for low credit-rated papers. And Templeton, of course, had taken this call with an isolation case, which is related to their portfolios, the way the portfolio is constructed, and the way they actually creating liquidity on the instruments to meet the redemption and so on and so forth, being an open fund. And probably they would have faced a problem of rising liquidity for some of these illiquid papers they have in their portfolio, and therefore they have taken this call. It's an isolation case. I think it should not be seen as an issue for the whole mutual industry, and given the fact that the entire mutual industry manages close to about 15 lakh crore, and all of them together would be owning about 90 to 93% of the portfolio in the high quality papers in most of the funds in which the retail investors have been participating. And the investment that is for what talked about a credit related fund, in proportion to the overall size, is very, very small. Therefore, the broader perspective, the schemes which are across the maturities, one should not feel any concern given the fact that all of us are running high quality credit papers with high liquidity being available. And that's something should give the comfort. Therefore, Templeton should be seen as one isolated case within the mutual fund industry space.
All right. So you're saying this is not an isolated case, but a lot of investors are, I mean, you are saying that this is an isolated case and it shouldn't be generalized now across the industry. But there are many investors who are worried specifically about this right now. And Nilesh Shah, if I can ask you, you know, can this become an industry-wide phenomenon? Because There are many people who are now asking, what if other asset management companies go down this same route? Should they stay invested in mutual funds? Should they now be thinking about withdrawing their money? What is your advice to them?
So definitely, if everyone rushes to withdraw money from a financial services company at one go, that kind of panic reaction will undoubtedly create unintended consequences. My recommendation to investors will be, please look at wherever you have invested the portfolio of that scheme. Get comfortable with the credit quality of that portfolio. If we are invested in treasury bills, government securities, public sector undertaking bonds, AAA rated corporates, vis-a-vis if we have invested in BBB or lower rated papers, clearly those are two different things. One is apple, other is orange. So you must look at individual schemes, credit quality and liquidity profile, and get your comfort that what happened with one fund house will not be repeated with other fund houses, because our credit quality, our liquidity profile is completely different. But clearly, if everyone rushes to get out at one point of time, I mean, portfolios are not geared for that kind of construction.
Nimesh, would you like to add to that? Because I think the worry is that this is a time when, there's lockdown, people want access to cash, they find themselves in a situation where they're worried about what might happen to their investments. So what if we see now a whole lot of redemptions? Are other asset management companies ready for that? All right, we'll try and go back to Nimesha in a moment, but let's have the same question to Dhirendra Kumar if we can.
Yeah, I have the same answer that, if all investors turn up to take their money back, any fund can be in trouble. But yes, this is the first, this is the first casualty in the sense that these were the biggest. Franklin fixed, credit funds exposed to corporate debt, they were the largest. And they have had, problems earlier as well in their portfolio. In fact, if you look at, there is something called side pocketing, a segregation of a portfolio. If a fund faces a credit issue, it is able to keep it aside, and then from there on, the fund carries on with that markdown. So in 3 of these 6 funds, there were 3 segregations. In two funds, there were 2, and the largest fund, the Franklin India Ultra Short Term Bond Fund, it just had 1, but that was amounting to about 7% of the total assets. That is on account of, that Vodafone Idea exposure, which is due for maturity in the month of June. So I would say that, when investors see their money getting scaled down or getting marked down periodically, it is understandable for investors to, earlier investors were chasing return, and now they were seeing this big hit, big dent on their investments, and understandable for them to get concerned and pull their money out. So my short answer is that yes, this is a problem. The outlook for the economy also looks grim. If businesses remain locked down, such funds will remain in trouble. So yes, it can't be ruled out. It is a very uncertain future. One should err on the side of caution, and all other funds, they might have greater preparedness in terms of liquidity. They have greater liquidity. They have superior quality. But the problem is not of a quality of paper only. Here it might be relatively poor quality as compared to others. But the real problem right now is the absence of a market for all the investment that these funds have made.
Okay, so the question really is, at this point, many are now comparing this wind down in a sense to this lockdown that we find ourselves in. Just as we're not being able to step out of our homes or do all the various things we would like to do, these schemes will not have any further transactions, purchases, redemptions. So what does this mean specifically? There are lots of questions that are being asked about this right now. What happens to an investor's investments in this wind down? Can he redeem? When is he going to get his money back? If we can just address some of those basic questions. Nilesh Shah, if you would like to answer that.
See, essentially, this answer is best answered by Templeton because they know their portfolio and what they are doing. But I would like to reassure investors in different categories. So there is one equity fund. While the problem has occurred in what is known as credit risk fund, there were investors who were worried that, oh, what if you stop redemptions in equity fund? Now, my submission is that nothing has changed for equity funds today, which was not there yesterday. We have redeemed equity funds yesterday. We are in the same position to redeem on today as well as tomorrow. So please don't link equity funds with credit risk fund events. Then another set of investors have come on overnight funds or liquid funds where they park money for short term. Now, in overnight funds, we get back all our money at one day. This is coming from a collateralized system where we have lent money only to the banks. Now you are going to put money in the same banks where we have lent.
Right.
So there is no way overnight funds can have a problem. Then I am saying that you look at portfolios of liquid fund, ultra short term fund where people are putting money for short term. They have treasury bills, they have government securities, they have commercial paper, certificate of deposits. These are liquid market, they are functioning market. We are able to sell and buy in those markets even in this lockdown. So there is no reason to believe that in those funds we have to put any restrictions. Then comes low credit risk funds like short-term bond funds, PSU bond funds, corporate bond funds.
Okay.
Again, there we don't see any problem there.
Okay. Nilesh Shah, without going into that much detail at this point, we really want to keep this broad specs for our viewers tuning in and answer their specific questions as well. Vijay is on the phone line with us from Delhi. Vijay, go ahead with your question.
Yeah. Good afternoon, everybody. Thank you for this panel and really appreciate your answers to everything. I've got specific two questions looking at the Franklin debt, which is having problems. I've got something with my mutual funds, which I am doing a regular SIP and some in liquid funds. Now, I want to know what the future is. That's the first question. When there's certain amount of uncertainty in the market, and if at all there's an advice to mutual fund advisors who are on the verge of getting retired in the next 4 or 5 years, what could you advise on an immediate action once the lockdown or something comes to an equilibrium?
All right, Nimesh Shah, I believe you're back with us. Would you like to take that question?
I was not able to hear it fully.
All right,
but I understand he's
yes.
Okay, then
He's asking how should investors look at mutual funds now, and particularly if you were wanting to exit a mutual fund now, or in the next sort of immediate term, as it were. What is the advice that you would give such an investor?
See, in my mind, whatever has happened, it was a specific one particular AMC incident. It has got nothing to do with what is happening in the market today. So ultimately, you are trusting a brand when you are giving your money to the brand. So you look at the brand. If the brand is right for you, is the brand in India for a long term, whether they are going to do business in India or they can suddenly close down business in India. Those are the things that one would look at. So the way you would look at mutual funds 2 days back, that before the Templeton event, is the same way that you should look at mutual funds today. Mutual funds are regulated quite well by the regulatory agency. And as far as debt funds are concerned, as long as you're in...
But Nimesh, may I just quickly interject? We've just also heard from former SEBI chief UK Sinha, who wrote an article about this in the Indian Express, and he says the problem of the mutual fund industry can swiftly migrate to the entire financial services industry and might then spread to the real economy as well. And he's certainly not seeing this as an isolated incident. So, how would you explain that?
See, since last 1.5 years, since October 2018, the media has been talking about mutual fund industry, problems in mutual fund industry. There are no problems in mutual fund industry per se. Each fund is independent of the other. Each fund is different from the other. So when we are talking about credit issues, so I represent ICICI Prudential. In ICICI Prudential, there were no credit issues in the entire tenure of the last 1.5 years. So that's what I'm trying to say. Each fund is different. There is no such thing as that the problems of the mutual fund industry. Templeton had a problem. They had to issue. Is there a higher redemption right now? Yes, there will be higher redemption. We'll address those redemptions. So even if there is a problem with specific fund houses, it does not mean the entire mutual fund industry is in problem. And the next one, mutual fund is regulated by SEBI, right? So whenever there have been issues, SEBI and RBI have come together and will find a solution. We will hear in the next 24 years, I'm sure the regulators will give the comfort. There is liquidity in the market. There is a comfort required. There is confidence required. I think that's where the regulators will step in.
All right. On that question of regulators, and we've heard, former Finance Minister P. Chidambaram also talking about the need for regulators to intervene, and we are getting lots of questions on that. So I'm going to just quickly run you through some of those questions and then come to you for a combined answer. We have a question from a viewer who says, is the Franklin Templeton instance, and this is, from the overall standpoint of the economy, he asked, is this symptomatic of a deepening malaise in the Indian economy, and is the government doing enough to help small investors safeguard their investments? Mr. Balasubramaniam, if you'd like to take that.
Yeah, I think one has to look at the whole issue. One, of course, what we are currently discussing about mutual fund. I think we need to also look at it for the financial market stability, the bond market stability, the bond market liquidity is available. And second is from the borrower's point of view, to run the business without any disturbance, how they are able to tap the resources from the banking systems. Therefore, any incident that happens in the financial market, though we are talking about the mutual fund, at the end of the day, all of us are interlinked. As Nilesh mentioned, that whatever money we raise, we actually put the money in bank deposits, or banks security deposits, or lend money to the companies. And anywhere the cycle becomes an issue, it cannot be just restricted only to the mutual fund issue, it becomes the financial market issue. What I think the former Finance Minister Chidambaram mentioned about, I think we had a similar problem the year 2008 after the Lehman Brothers crisis. And it was, the presentation was made by the mutual fund industry and IMT as a body. We worked with the SEBI, we worked with the RBI, and worked with the Ministry of Finance. And they came with actually a special line of credit actually for the mutual fund, just to ensure the panic gets arrested, the liquidity is being provided, nobody does a fire sale of securities, therefore it doesn't impact the whole financial market. And that's something which the Reserve Bank of India has been doing with the last, from 27th of March by providing liquidity in the banking systems in the form of an LTRO. They also considered some liquidity facility for the mutual fund by the secondary market securities. Probably more such measures in a continuous basis if it is taken, it can actually boost the confidence, also will not change the financial market. I think stability of the financial market is more important, and mutual funds being the large players of getting the public savings in mutual funds also need to get the sufficient liquidity whenever there's a need for liquidity. Well, of course, all of us will be managing, as Nimesh mentioned, that all the fund houses are managing it in their own way, and so far nobody has seen any accidents other than what we have seen in Templeton, so it cannot be generalized for everybody. At the same time, one has to look at the big picture, that providing a financial stability in the market is important. Therefore, mutual funds should also get that support, which in my view would come from the appropriate authorities as we move on.
So what kind of support would this be, Dhirendra Kumar? What would you like to see, for instance, from the RBI, from the Finance Ministry? Do you believe that any kind of direct intervention is required at this point before this becomes a system-wide contagion?
Yeah, I think, there is a need for there's an urgent need to have a mechanism where somebody can have a live active market. Somebody should be able to hawk these portfolios urgently, because all these policy measures, everything is fine. But when investors turn up to take their money back, there has to be a backstop arrangement of being able to sell the securities. This is, as of now, this is not a credit issue. As of now, there is an absence of a market because of complete risk aversion. Complete risk aversion where nobody, think of a situation that the stock market opens but nobody is buying it and there are only sellers, or stock market doesn't open. That is something which has happened in the credit market for these funds, for the underlying security which this funds hold. So in that sense, there is an urgent need, and this requirement is not required on an ongoing basis. In normal conditions, if funds get some redemption requests, they get some inflows, and sometimes the inflow is less than the redemption, like so on and so forth. They are able to manage it.
Right.
When most people are actually turn up to queue up, and they have reason to.
Yes.
The outlook for the economy remains grim. Companies which were weak are not likely to get stronger in times to come. So that is actually a foregone conclusion. Every reason why investors will panic, and we need a special arrangement to pacify that.
Okay, but Nilesh Shah, speaking of a mechanism, is there something that, for instance, your body, the Association of the Mutual Funds in India, can do to prevent a recurrence of such an event? You know, a decision of one asset management company can clearly have an impact on all other AMCs also, as no doubt you are all feeling at this point. So, can there be an internal mechanism of any kind that can head off something like this?
So we had seen in 2008 subprime crisis where one or two mutual funds decided to kind of shut down their funds for redemptions, but other mutual funds continued their business as usual. As Nimesh mentioned, each one has a different credit quality, each one has a different liquidity profile. So at least in 2008, decision taken by one or two mutual fund remained isolated event. It didn't have contagion effect on the entire industry, and we conducted business as usual. But as Bala mentioned, that was the time when we had regulatory support like we have today.
Right.
Undoubtedly there were concerns, and those concerns were addressed suitably by doing show like this, so that everyone didn't rush to redeem from mutual fund, and because there was no bunched up redemptions, we were able to manage our portfolios reasonably well and conduct business on a normal basis.
All right, Nimesh Shah, if you want a quick last question to you, how do other asset management companies now prevent investors from panicking, from from making redemptions? What, if there's one message you would like to give out at this point, what would that be?
See, it's a very simple one. Suppose you are going in by car from Bombay to Pune. You would there will be one particular car which is running at 140 kilometers per hour, and there are other cars which are going at 80 kilometers hour, 90 kilometers hour. And the 140 kilometers car, the car which is running at 140 kilometers, meets with an accident. What does that mean? Do you stop driving? Do the others stop driving? The others have to check their brakes. Are the brakes okay? Are the accelerator okay? Is the engine okay? And they'll continue. Same way in our industry, when you talk about speed, here you talk about interest rate. If one particular fund house was giving extra return, why did people move to that fund house? Because that fund house was giving extra return, right? He was giving 1.5% more than what anybody else could give. How could he give more return? By taking more risk. So people took more risk when they were investing in that particular fund house. So that is why that was the first one which met with an accident, right? Now the whole regulatory mechanism is behind us, and essentially the portfolio, at the end of the day, you have in a debt fund, you have given money to people. As long as your debt is very clear and you believe that the money that you have given will come back to you, then there is absolutely no issue. Even when you are trying to sell the portfolio, if the security is such that it is sellable in the market, you will be able to realize it, right? So that's the issue, the quality of the portfolio and the brand associated with that quality. Did the brand have sufficient risk management practices put in place?
So would you at this point then encourage investors to keep on investing?
I would surely say that this is in a deflationary environment. In India today, we are in a deflationary environment. In a deflationary environment, investing in debt mutual funds is the best option possible, right? And that is why in a deflationary environment, I believe debt funds are a superb option for retail investors to invest in.
All right, we'll leave it at that. Thank you all for joining us on the program today and answering a range of questions. We hope our viewers' questions have been answered at least partly. We'll continue to focus on this. Thanks for watching.